There's more than one way a company owner can be remunerated by a company. For an employee, it's a question of paying a salary, perhaps with a performance-related element such as a bonus, but basically it's remuneration paid through the payroll and under PAYE. A company owner, however, can be remunerated with a salary like an employee, or he can be paid with a dividend, which is the way an investor in a company gets his reward. Or you can throw in some other things into the mix, such as company pension contributions or even company cars. It's a question of formulating a remuneration strategy and then keeping it under review because the tax rules are constantly changing. For many years, dividends had a distinct advantage over salaries because of the NI costs that go with salaries for the employer and the employee. But finally, the government noticed the disparity between the tax rates for salaries and dividends, and they acted to reduce it by adding 7.5% onto the dividend tax rates. That hasn't quite removed all of the advantages of dividends, but it's gone a long way towards creating a level playing field. The fact that the corporation tax rates are edging down to 17% over the next few years does restore some of the advantages of dividends. A very common tax-efficient remuneration strategy is to pay a small salary, around £8,000, just up to the NI threshold. This keeps the NI record alive for state pension purposes, and then pay the rest of the remuneration in the form of dividends. You should aim to use at least the lower rate tax bands, but it all depends on the individual's income requirements. Possibly you could push the salary up to the personal allowance. It depends whether the circumstances allow you to take advantage of the employment allowance, which mitigates some of the national insurance costs. Probably the one other thing to add into the remuneration mix is company pension contributions. There have been successive rule changes for several years which have reduced the scope that you can take for pension contributions, but it makes sense to use the tax breaks that remain. There are a few areas to be careful of. Employment intermediary rules. For some, there are rules that prevent you taking advantage of dividend-based remuneration strategy. Company cars can be tax expensive. Think carefully before you throw those into the remuneration mix. And finally, dividends or salaries for a spouse. Salaries have to be earned to be justified, and when it comes to dividends, just have a look at the anti-avoidance legislation to make sure there isn't something that prevents it. At the end of the day, it's a question of taking advice, formulating a remuneration strategy, and then keep it under review.